So good morning, everyone. Let's go ahead and kick off our webinar, Financial Considerations for the Baby Boomer Generation. Again, thank you for joining. My name's Gina Buchholz. I'm one of the advisors at 401k Plan Professionals. And this generational series it's new. It's something we've done specifically for some of our clients, and it was very well received. And just acknowledging that a 25-year-old has very different financial concerns, financial challenges, financial objectives than somebody who's 60 years old. So that's why we broke it down by generations. Especially, baby boomers definitely have some specific concerns, worries, and I hope today's presentation will give you some actionable items to employ, help you get to retirement. So we've got a lot to cover today. There's a lot of things that baby boomers are thinking about. So again, thank you. And on behalf of our team, Jessica, Jenna, Virginia, and myself, again, just appreciate that you join these webinars and empower yourself with a little bit more financial literacy. All of our webinars are recorded. We have 18 webinars scheduled in 2026, and we do have some of our most popular ones coming up. We do have Social Security and Medicare. I'm going to scratch the surface of those two topics. But again, those two topics are complex and definitely merit their own separate webinar. But again, we'll scratch the surface of Social Security and Medicare today, but we'll start off by talking about some of the financial realities for the baby boomer generation, considerations to help you pursue your retirement goals. Because let's face it, one of the biggest things, one of the biggest priorities for baby boomers is being able to retire when you want to retire. So we're going to talk a lot about that. And then, of course, we have tons of resources available to you. So again, let's jump right in and start talking about some of the financial realities for baby boomers. Baby boomers specifically are people born between 1946 and 1964. That's 70 million Americans in this baby boomer generation. And it's interesting because I kind of define them by older baby boomers. Older baby boomers were impacted by things like the civil rights era, Vietnam, presidential assassinations, Watergate, where younger baby boomers were impacted more by a lot of economic turbulence. So those younger baby boomers, born between maybe the mid 1950s and the mid 1960s, they saw high inflation, high interest rates, the oil embargo, the Iranian hostage crisis. As I'm saying this, some of this sounds familiar today, right? Inflation, higher interest rates, an Iranian regime. But they're kind of two different groups. Again, older baby boomers and younger baby boomers, just impacted by some different experiences. But the one thing I think baby boomers do share is baby boomers were caught in this shift of retirement savings. Baby boomers probably saw their parents have Social Security benefits and a pension. Their parents probably didn't live long. My grandfather lived to be 69. He did have Social Security, he had a pension, but he didn't live very long in retirement. Again, he wasn't really worried about saving for retirement. That was kind of taken care of for him. But baby boomers saw this shift where that responsibility started to fall more and more on their shoulders. So, not surprisingly, one of the highest priorities and one of the biggest concerns for baby boomers is saving for retirement. So that we're going to talk a lot about that today. And one of the challenges is those rising healthcare costs. Talk about that. Baby boomers are worried about outliving their retirement savings. They're struggling to understand Social Security and Medicare. They're trying to prioritize paying off your mortgage, your debts, credit cards. And the other thing baby boomers should start thinking about is an inheritance or some type of a financial legacy for their children or grandchildren. Might be something you at least want to think about, and we'll talk a little bit about that as well today. So let's pause for a moment. I'll let you daydream for a minute. Think about what you want your retirement to look like. Again, this is top of mind for baby boomers. So what do you want your retirement to be like? I talk to some people and they want to travel extensively. They have expensive hobbies. They want to take their kids and their grandkids on elaborate trips. That's a pretty lavish retirement lifestyle. It's probably going to cost you a little bit more. I talk to other people and they're like, you know what? I could just live at the cabin. I can fish. I can hunt. Pretty happy. So you want to think about, how do I want to live my retirement years? And of course, how much is that retirement going to cost? And one of our general rules of thumb that most retirement or most financial advisors would tell you is most Americans probably need between 70 and 90% of their pre-retirement income to continue to live and maintain the lifestyle that you're used to. So most people don't need 100% unless you're one of those that want to live a really extravagant lifestyle. But there's a number of costs that go down. We're going to talk about the one cost that's going to go up, and that's medical expenses. But again, 70 to 90% of your pre-retirement income is probably what you need to live off of every year in retirement. So that's, again, a general rule of thumb, but your lifestyle is going to play a big part in that. And then, of course, the other thing you want to think about is I need to make my money last. Gentlemen, you have a 50% chance of living to age 85. You have a 25% chance of living to age 92. Ladies, we have a 50% chance of living to age 88. We have a 25% chance of living to 94. So you can see if you get to age 65, if you and your spouse get to age 65, there's a pretty high likelihood, or at least over a 50% likelihood, that one of you will live into your 90s. That's 3 decades that you may live in retirement. So it's good, but you got to make sure your money can stretch that long too. So that's another challenge, obviously. So let's talk about some of the practical things that you can start doing today. And I will say, I'm just going to pause here, and I will please put any questions you have into the Q&A. I'll pause a couple of times and make sure I try to catch those questions, okay? But a couple of things we're going to talk about. Start maximizing your retirement savings and your HSA. That's the lowest hanging fruit you're going to get. So we're going to talk about what those limits are and why that's important. Again, I'm going to talk just a little bit about Social Security and Medicare, but we'll get into a deeper dive in those in our separate webinars. Talk about paying down mortgage, other debts, and creating an inheritance and maybe some estate planning as well. So here's one of the things that should be top of mind. You can maximize your 401k. The limits are very high. And I know this is hard for a lot of Americans. I'm not expecting you to maximize it, but if you're in a position where you can, kids are out of the house, maybe both of you are working now, maybe you finally have that opportunity where you might be able to max out your 401k savings. The limit this year is $24,500, but for those boomers, you're probably 50 and older, so you have a catch up of $8,000. So that means if you're 50 or older, for 2026, you can contribute $32,500. So it's this plus the catch-up, that's $32,500. They've also added a super catch-up. If you're between the ages of 60 and 63, you can contribute this, $24,500, plus this, that's $35,750. Again, that's specifically for people between the ages of 60 and 63. The reason Congress did this is because they know these baby boomers probably started out slow, right? And they're trying to catch up. So that's a nice benefit. Again, I know those limits are high, but think about possibly maxing out if possible. If you have an IRA, if you're taking advantage of IRA contributions, the limit went up to $7,500. If you're over 50, you have an additional $1,000 catch-up. So if you're over 50, want to contribute to an IRA, your limit's $8,500. Also, HSAs. We're going to talk about HSAs. HSAs, again, low-hanging fruit, excellent tax benefit. We're going to talk about how important HSAs are going to be to help you deflect some of those healthcare costs. But the limit is now $8,750 for a family. If you're 55 or older, you get that extra $1,000 catch-up. So if I'm 55 and older, my spouse and I can contribute $9,750 this year into our HSA account. So we're going to talk about Again, we'll get to the HSA here in just a second. Actually, we're going to get to it on the very next slide. Um, so the reason I love HSAs, triple tax savings. It's the best vehicle for tax benefits. It's also going to be really important. So any HSA contributions are pre-tax. So it's going to lower your taxable income this year. That's great. You also probably have an opportunity in that HSA account to invest it. Invest it like your 401k. The money will grow tax deferred just like your 401k. And here's the final kicker on that HSA. You can take that money out tax free for any qualified healthcare expenses. The beauty is there's no use it or lose it. So here's an example I always use when it comes to the HSA. Let's say you have to have a root canal and a crown. Those are not cheap. You decide to pay that out of pocket. But you know what you're going to do? You're going to keep that receipt. Let's say it's $1,500. You paid it out of pocket. I'm going to keep that receipt because that's my golden ticket to get $1,500 out of my HSA at some point down the road, whenever I want. It could be 5 years down the road. It could be 20 years down the road, but I got to save that receipt. Really, really important. There's no use it or lose it. So a lot of baby boomers are starting to figure this out. Hey, let's set up that HSA. Let's take advantage of the tax benefits. But also, if possible, let's pay our medical costs out of pocket and keep the receipts so we can get the money out of the HSA later. I know when we were younger, we had an HSA account, but I had kids and there was always something going on. Somebody needed braces, somebody broke an arm. So we were always taking money out of those HSAs. Now that my kids are older, my husband and I are trying not to touch the HSA, let it continue to grow and accumulate, but we're still keeping all of our receipts. So anything we pay out of pocket, we're keeping those receipts. And then we can get access to that HSA account later. So again, just to recap, there's no time limit to use the money. There's no use it or lose it. Triple tax savings. It's pre-tax. It grows tax deferred. You get to take the money out tax free, which is kind of like Roth. So it's pre-tax and Roth together. You can, in most HSAs, you can invest that money. So if you want to save it for later, I'd suggest maybe investing it similar to your 401k. And again, those withdrawals are tax free for medical expenses. So again, HSA, in my opinion, pretty low hanging fruit. Take advantage of it if you have access to one. And you're going to appreciate it because this next slide, I think, can be a little bit astonishing. This is healthcare premium costs for a 65-year-old couple. So what this estimates is the cost of your Medicare Part B and D, supplemental insurance, dental insurance, and out-of-pocket. Okay, so good chunk of your medical care costs. Doesn't include prescription drugs, doesn't include everything. And this also expects that the male will live till age 87 and the female will live to age 89. And they're under the income threshold, they're under $170,000 retirement income. But look at how that increases as this couple ages. From age 65, look at how much more those healthcare costs are projected to be at 75 and age 80 and age 85. These are annual costs. These are your monthly costs. And again, this is with the benefit of Medicare. So we're projecting that the 65-year-old couple on Medicare is probably going to spend over $600,000 in healthcare costs. Now, I know one question people always ask me, can I use that HSA to pay for my Medicare healthcare premiums? Not directly, but in a roundabout way. If I had that $1,500 from a root canal 10 years ago, I can get my $1,500 out anytime I want, right? So kind of in a roundabout way, you can still use that HSA and pull money out of it as long as you have the receipts to support those medical costs. Okay. Another thing that we always talk about, people will tell me, hey, I want to retire when I'm 60. My wife and I really want to retire when I'm 60 or 62, but they want to retire before they're eligible for Medicare. If you retire, you also don't have the benefit of an employer-sponsored health plan. So, what does that mean for a 60-year-old couple who wants to retire? They don't have employer sponsored health care and they don't qualify for Medicare. That means you're going to shoulder the entire cost of your medical expenses. So I did a little Google search the other day. So I'll give you how much, I went out to the private marketplace, how much would private Medicare medical costs cost the 60-year-old couple? And it was somewhere between $2,100 a month and $2,700 a month. That's going to vary by where you live, your healthcare network, things like that. So, but that's about what that couple would pay. That's $25,000 to $32,000 you would pay annually. Again, I'm talking about people who retire before they qualify for Medicare and they no longer have an employer sponsored healthcare plan. So that is a huge cost. So that's one of the biggest things that I ask people if they want to retire early. I ask them, have you gone out to see how much is your medical costs going to be? Because you have to shoulder that whole burden. So another thing, again, as I mentioned, that's the one cost that is probably going to go up in retirement. Couple other things you might want to think about. A lot of people I talk to approaching retirement, they really want to get that house paid off. Don't blame you. Pay off the house. But you want to think about some other things too. Think about your overall financial health. Don't jeopardize your emergency savings. You still need to have money in emergency savings. You still need to achieve your retirement goals. Consider other debts. And know that your home mortgage is usually a good debt. And if you're lucky, some of you might have that mortgage at a really low interest rate. Maybe you refinanced it back in 2020 or 2021, and you're at, maybe a 3% interest rate on your mortgage. You could probably save and invest your money and get a better interest rate. So interest rate, that's kind of something you want to think a little bit about. But one thing you might want to consider is paying down a little extra each month on your mortgage. It can make a huge difference. Or make an extra payment every year, maybe change to biweekly payments instead of monthly, or refinance it at a lower interest rate. But I want to give you a quick example. If you're thinking about maybe paying down your mortgage, here's an example. You'll find these mortgage amortization calculators probably on your mortgage loan website. This is from Rocket Mortgage, so it's a really easy, calculator to use. But I just use an example of $150,000 outstanding. That's your outstanding mortgage. That's what you owe on your house. You got a 7% interest rate, and you want to pay $100 extra. Okay, so you just want to pay $100 extra every month. How would that impact your mortgage? Well, in this scenario, you would save over $41,000 in interest, which is fantastic. And I'd have that mortgage paid off in 5.5 years faster. So it doesn't, if you have that a little extra, an extra $50, an extra $100 every month, it could really make a big difference and help you get that mortgage paid off, maybe by the time you retire. So something else to think about there too. I'm just going to pause here real quick. I see we got a couple questions in our Q&A. I'm on the very end of the baby boomers, 1964. Yeah, there is a big difference between older boomers and younger boomers. Yeah, and I agree, and I do acknowledge we don't want to put too many labels on baby boomers. So I appreciate that. Flexible spending accounts. So yeah, great question. We talked about the HSA, and some of you might have access to a flexible spending account. So the biggest difference, in my opinion, is a flexible savings account. You got to use it or you're going to lose it. So the flexible spending account, you have to use it by the end of the year, or usually by March or April of the following year. You got to make sure you use that. The beauty of the HSA, I don't have to use it. I can save my receipts and I can pull money out of my HSA whenever I want. 10 years down the road, 20 years down the road, that's the biggest difference. Yeah, healthcare costs are insane. Will we ever see reform? Yeah. I hope so. It's a big topic of conversation, and two things that I would suggest you pay a lot of attention to. Um, the next two presidential elections, 2028 and 2032. There's going to be two big topics that we're going to talk about: affordable health care and Social Security. Because in 2033, Social Security is predicted to not be able to pay out the same level of benefits unless we do some type of Social Security reform. So those are two things that you're going to hear a lot about in the next two presidential elections: affordable health care and how are we going to keep Social Security sustainable. And actually, that's a good segue because we're going to talk about that here in a second. A couple of the things I want to throw out there, though, we do have 8 steps to becoming financially well. In that video series, we talk a lot more about HSAs. And we talk a lot more about paying down, other debts and mortgage. So we take a deeper dive. That's a great video series, 8 steps to becoming financially well. Takes a little deeper dive in some of those topics we just talked about. But let's talk about Social Security. We'll start there because one of the things when people ask me, how much am I going to have for retirement? I say you need to start creating a budget. And where I would start is how much are you going to get from Social Security? That's how you start your budget. Then we'll factor in other retirement savings, pensions, other benefits later. But you got to start with Social Security. Okay, that's your baseline. Go to ssa.gov. If you haven't created an account, please do. I even tell 20-year-olds to do it. Go in, sign into your account. First of all, it will secure your account, help prevent fraud. You'll get a username, a password. If you struggle with going online, hey, ask a kid or a grandkid. They'll help you get logged in. But it really is a pretty easy website to log in. Again, ssa.gov, go and sign in at login.gov, walks you through a couple of steps. You'll be able to put in all of your indicative information. But this website gives you so much information. It's a great starting point. And I just talked to somebody the other day. They said it took them 3 months to get an appointment with the Social Security office. It's really tough to talk to a human being right now at the Social Security Administration. So I suggest gather as much information online as you possibly can. And here's some of the things that you can pull from that Social Security website. You can pull a statement. I am of the generation, I no longer get paper statements. Some of you might, I don't. So I have to go to ssa.gov to get my Social Security statement. Couple interesting things that you want to check. It gives you all of your earnings history, 30 up to 35 years of earnings history. So check it, make sure it's accurate. And then of course, I think one of the most important things it gives you is this projected monthly retirement benefit. Age 8, starting at early retirement, age 62, your full retirement age, which for a lot of us is age 67, and then your maximum Social Security benefit, which would be at age 70. So, of course, those benefits are going to increase the longer you delay it. But that is a really good starting point. And guess what? Have your spouse go on there too. And then, you can start talking about, okay, when do we want to retire? Do we want to wait till full Social Security? How much projected income are we going to get from Social Security? So that is a really, really good starting point. Couple other things about when do Social Security benefits start. If you were born between 1943 and 1954, you can collect full Social Security benefits at age 66. Between 1955 and 1959, it's kind of a weird age, could be like 66 and 6 months. If you were born 1960 or later, your full Social Security age is 67. Okay. So this, by the way, this changed back in the Reagan administration. So a lot of people think that Congress may extend the age to collect Social Security, and they very well may. I mean, we're living longer. It probably makes sense to do that. That would be one thing that they could do to salvage Social Security benefits. But again, they're not going to do it for people who are approaching retirement. Okay. Again, this was done back in the Reagan administration. It's just now affecting me. So They gradually, it's going to be for future generations. But I'm guessing my kids, they might have to wait until they're 70 or 75 to collect Social Security. I'm just guessing, but that may be one of the remedies to salvage Social Security. But anyway, if you're born after 1960, collect full Social Security benefits at age 67. And here's how it works. Let's say my full Social Security benefit at age 67 is $1,000 a month. If I decide I want to retire early and collect that at age 62, I get 30% less. So I only get $700. Every year I delay it, I'm going to get a little bit more. And I can even delay it past my full Social Security age. I can delay it to age 70. Every year it's going to increase by 8% if I delay it. Do not delay it past age 70. There's no benefit in doing that. You're just going to lose money. So you can't, but that's the maximum age you could delay it to. And that's when you and your spouse would get the maximum Social Security benefit. Okay. So again, encourage you to log into Social Security, ssa.gov, and start gathering some of that information. Very, very important to creating your budget. The other thing I want to mention, because I get this question all the time, I'm going to retire when I'm 62, or I'm going to retire when I'm 64, but I'm going to keep working. If you start collecting Social Security early at 62, 63, 64, whatever, you start collecting Social Security early, you want to be careful if you continue to work that you do not make over the earnings limit. Because if you do, they're gonna withhold those Social Security benefits from you. So you want to be very, very cognizant of that. For 2026, if you are collecting Social Security benefits early, you can only make up to $24,480. This gets indexed every single year. If you wait until full retirement age, so if my full retirement age is 67, and I'm like, I'm going to keep working, I can make as much money as I want. Doesn't matter. So this is only an issue if you start collecting Social Security before your full retirement age. You want to make sure you don't make over the earnings limit. So that's something that's really, really important. I've run into a lot of folks that have run into that issue. Medicare, just a couple things about Medicare. Again, we have an entire webinar coming up on Medicare, just scratching the surface here. But keep in mind, you enroll for parts A and B through the Social Security system. So another reason you want to log into Social Security at ssa.gov. If you're already receiving Social Security benefits, you'll automatically be enrolled in Medicare at age 65. And your initial enrollment period for Medicare begins 3 months before your 65th birthday, and it can be 3 months after your 65th birthday. Okay, so 65 is really, really key to ensure that you enroll in Medicare benefits. So for instance, if my birthday is May 20th, I can enroll as early as February 1st and as late as August 31st. Okay, so make sure that window is really critical. I wish I had more time to dive into Medicare, but such a huge topic. That's why we do our Medicare webinar every single year, and that will be coming up. In fact, let me tell you when those webinars are coming up. We got Social Security next week. This is going to be with our presenters. They presented last year. They are Social Security subject matter experts from MFS Investments. So again, you can feel free to register for that on our website. You can use our QR code. Again, with all of our webinars, if you register, you're going to get the recorded link. You can also find the recording out on our website at 401kplanprofessionals.com. So make sure you have all of those resources. So again, Social Security, we're going to take a deep dive into that next week, same time next Thursday. And then, of course, Medicare, Ron Bezos, backed by popular demand. He does a fantastic job. Another subject matter expert on Medicare. That will be in September. If you want information about Medicare, our recording from last year is also out on our website at 401kplanprofessionals.com. So we do have that recorded from last year if you do want some more information on that. So I'm going to pause here. I have just a little bit left, but I want to make sure I answer a couple of questions here. Oh, what happens if you miss that window? There could be some late penalties that would apply. So you don't want to miss that window. So again, they'll kind of explain that, but don't try not to miss that window. If you're taking Social Security benefits early and you're already taking Social Security at age 65, you're already automatically enrolled in it. So that's not an issue. But if you get to 65 and you're not taking Social Security benefits, don't miss that window because they could apply additional penalties. And my understanding is those penalties may never go away. Oh, and if you're still working, a great question. You probably do not need to enroll in Medicare. There's a couple of caveats to that, and we'll cover that in the Medicare webinar. But that's a great question. If you're still working at age 65, you're covered under an employer-sponsored retirement plan, you probably do not need to enroll in Medicare. There are some forms that you may need to submit in certain circumstances. So just make sure we do cover that in the Medicare webinar. But great question. You generally do not. Again, few little caveats there. So let me just check here if there's any other questions. So oh, will I be taxed on taking Social Security at 62 instead of 67? Well, depends on what state you live in. If you live in Minnesota, yes, quite possibly. Depends on your adjusted gross income. But yes, you may be taxed on it, whether you take it early or at full retirement benefits. So, all right. I'm going to wrap up with a couple things here, and then I'll get back to any questions that you guys have. I know always a lot of questions on Social Security and Medicare. So I'm glad we have some additional resources. But other thing that you might want to think about, please designate your beneficiary on your 401k account or any retirement savings accounts. Please log in to your 401k account, list your primary beneficiary, list a contingent beneficiary or beneficiaries. Really, really important. Want to give you an example. Yesterday, I got a phone call. Someone in one of our 401k plans passed away. His daughter called me. He didn't have a beneficiary listed. It's really tough. That's going to probably have to go through probate. Some state probates are so far behind. I know in the state of California, I've heard situations where probate is 18 months behind. So if you don't have a beneficiary listed on your 401k, your beneficiaries may need to wait months or even years before they get access to your retirement account. So make sure you have your beneficiary designation. You might also want to establish a will or a trust too. I also think it's a good idea, maybe think about having a durable power of attorney. My parents have that. I'm the power of attorney for them. If they're incapacitated, I can handle their financial assets. They also have a healthcare power of attorney. So that's also known as a healthcare directive. That just means your caretakers would be able to follow your wishes if you became very sick or incapacitated or disabled. So those are a couple of things that I'd suggest, but at the very least, make sure you have beneficiary listed on your 401k, your IRAs, any of your other retirement accounts. So that's an easy way to start. It is really a headache if you don't. And again, in absence of that, your loved ones may have to wait until it goes through probate. Couple other things you might want to think about doing. I call it a family love letter. Make sure you have written down all of your financial information for your loved ones, for your spouse, for your kids. Write down, where those accounts are, any accountants, your employers, financial advisors, attorneys. Also do the same. Write down any liabilities, insurance, and other benefits. Make sure you have all those health directives, power of attorneys, wills. It is someplace where one of your loved ones or some of your loved ones can find them. And you might also want to write down your wishes. What you care about, your family values, your charitable activities, traditions and wishes for future generations. But make sure, start organizing that because that's going to be really important for your loved ones. So a couple final thoughts that I want you to think about. Again, think about what type of retirement do you want? What type of retirement do you and your spouse want? When do you want to retire? Do you want to work part-time? The nice benefit about working part-time is that might enable you to delay taking Social Security And every year you delay Social Security, you're going to get a little bit more. It might also help you delay tapping into your retirement savings. So that can continue to grow and compound as well. Again, just be careful if you want to work part-time and you take Social Security benefits early, make sure that you're cognizant of those earnings limits. Think about how you're going to pay for healthcare, especially if you retire before age 65 and you qualify for Medicare. That's going to be a really big expense and probably one of the biggest expenses you're going to have in retirement. And then, of course, think about when you're going to collect Social Security. And, just because you collect Social Security at age 67 doesn't mean your spouse has to. Maybe you collect it at full retirement age. Maybe you have your spouse delay their Social Security benefits until age 70. I mean, there's a lot of different ways to slice that. And again, we'll give you a lot of different scenarios on that Social Security webinar. Start prioritizing retirement savings, HSA. Again, I gave you some great ideas right there. If you have an HSA, remember, there's no lose it or use it. Just hang on to those receipts. Anything you pay out of pocket, you'll be able to get that money out of that HSA account later. Work on paying down debts, home mortgage. Think about calculating your retirement income needs. This is a tough one because it varies, and this is one of the biggest questions we get. How much money do I need to retire? I'd suggest if you go onto your 401k website, a lot of times you'll find a retirement income calculator. Add information in there. It's going to help you determine how much your retirement income you're going to have. It includes Social Security, but you can add more information in there. Otherwise, schedule a one-on-one with us. We'll help you with that. So we're happy to do that because there's no generic answer to how much retirement income money you're going to need. That's very specific to each individual. Start setting goals, creating a budget, and again, organize those financial affairs. Before I check questions, I want to make sure you have lots of resources. Again, I mentioned you can schedule a one-on-one with one of the advisors at our office. We can talk about all of this, all of your concerns, your specific situation when you're thinking about retirement, where that money is going to come from. You can schedule that on our website, 401kplanprofessionals.com/office hours. You'll find a link on our website. It's really easy to schedule. You just find a date and time that works for you. You'll get a Zoom link. You can tell us what you want to talk about. And again, there's no cost to you. 30 minutes with one of the financial advisors at our office. That's awesome. Again, there's our team and our email addresses, our website, 401kplanprofessionals.com. Again, you can schedule office hours there. But again, access to all of our webinars, tons of webinars. Again, Social Security is next month. Medicare will be in September. Different generational ones, economic updates. Oh, and HSA. We do have an HSA webinar also coming up in August. Again, I scratched the surface of a lot of these topics, but if you want to learn a little bit more about HSAs, please join that one in August as well. Here is the whole list. Again, we've got tons of webinars, and you can register for some of those there as well. You can reach out to me if you have any specific questions too. So I'm going to pause on that slide so you have some of that information, and I'm going to go back and answer any questions. I know I went a little over our 30-minute allotted time slot, but I want to thank you guys for sticking around. I hope you learned a little bit about a little more about things you can do to get ready for retirement or anything that you're worried about as a baby boomer. Again, please reach out. We always love to hear from you. If you need to go, thank you. Have a great day. And again, I'm going to look at some of those questions here and hopefully get all those answered for you as well. Let's see. Okay. Oh, great question in the chat. I changed an email address for SSA. Only lets me log in under the old email, even though my profile shows the new email. I've had this question come up before. I think you're going to have to reach out to the Social Security Administration for fraud, obviously, to protect your account against fraud. They don't make this super easy. I think you're going to have to call the number at Social Security Administration, find out what they need to prove you are who you are, and then they'll be able to change that email address for you. So I know that's a tough one, but I've had that question come up. But reach out to Social Security for that. Social Security benefit in retirement based solely on your earnings, and is there an upper limit and maximum that you can receive? Yes and yes. So your Social Security benefit is calculated by up to 35 years of your earnings history. So number one, that's going to impact how much you get from Social Security. And yes, there is a maximum limit as well. So yes and yes to that question. Let's see. Oh, recommendations for attorneys. Yes, actually, I'd be happy to. Again, we don't, we just know a couple of attorneys who could help you with illegal wills and trusts. Email me and I'll send you a couple of recommendations for an attorney who could help you. Just email me, Gina at 401kplanprofessionals.com. I can send you some recommendations for an estate attorney if you need one. Let's see. And the phone number for Social Security, yeah, I know that's a tough. You know what? I learned a trick. Go to your local Social Security office, not physically go there, but Google your local Social Security office. Find the number to your local Social Security office. Don't call the generic 800 number. You're right. You will be on hold for hours. Find your local office wherever you live. Just do a Google search, local Social Security Administration, find their direct number. I have had people have a little bit more luck going directly to their local Social Security office. So try that. Let's see. Yes. Uh, okay. Okay, so I think I got those questions answered about Social Security. Again, factored by how much you make. It does not scale every year. Although I will say, Social Security, there is an inflation adjustment to Social Security. So what you see. What you lock in at your monthly Social Security benefit, that's what you're going to get. The only adjustment to it is you'll notice every year they will sometimes announce an inflation adjustment to your Social Security benefit. So that's the only time it'll adjust is with that inflation adjustment. The good news is it goes up. So a little bit. So yes. So once you're locked in, that is the benefit that you'll get. So great questions there. Great questions there. Okay. Okay. All right. Well, I think I got most of the questions answered. Again, we're going to take a real deep dive on Social Security and Medicare. And if you're really dying to know, our previous Social Security webinar, it is out on our website at 401kplanprofessionals.com. So you can grab that previous webinar. Again, we're going to have a fresh one next week. So even if you can't join it, it's at 10 o'clock on March 12th. Even if you can't join it, please go in and register for it. You'll get the recorded link. I tell people, hey, sit down and watch it with your spouse. You can kind of, if you have a recording, you can jump to the sections that really pertain to you. But just make sure that you do register for that. Let's see, what benefits will pass automatically to a surviving spouse without a beneficiary designation and what will not? Ooh. I can tell you some of them. I can tell you at least as far as 401k accounts go. If you don't have a beneficiary listed in the state of Minnesota, it will go to probate, but there is a pecking order. It'll go to your spouse, then it goes to your kids, then it goes to your parents, then it goes to your estate. But again, if you don't have a beneficiary listed on a lot of your retirement savings accounts, your 401ks, your IRAs, if you don't have a beneficiary, the problem is your spouse is probably going to get it. Or if you don't have a spouse, then your kids are probably going to get it, but it's got to go through probate. So they're going to have to wait. So, but that is the pecking order, at least in the state of Minnesota: spouse, then kids, then parents, then estate. So if that helps, but again, you can avoid a lot of headaches for your loved ones if you just designate a beneficiary. If you do set up a trust, Some people will put their assets in a trust. And then the trust designates where that money goes. So that's an option, obviously, too. Let's see. Yes, you're welcome. Thank you, everyone. Thank you. Thank you. Let's see. Uh, yeah, okay. So another question from Michael. Is there a benefit to delaying retirement on the assumption that the base benefit will adjust upwards? I realize that once you retire, you're locked in. So yes, I mean, and the benefit is tough. If you told me you're going to live until age 95, if you knew that for a fact, then you would definitely behoove you to delay that benefit to age 70. Like I said, it's going to adjust 8% every year. Age 68, age 69, age 70, the benefit's going to adjust 8% every year, plus any inflation adjustments as well. But to really determine was that a right decision or not, I think it depends on how long you're going to live. And that's really tough. Sometimes I run into folks and they're not in good health. They don't think they have a long life expectancy. Then it would probably behoove you to take your Social Security benefit as soon as you possibly can to at least get some benefit. So that's kind of the tough thing. There's no perfect answer there, unless you could tell me when you're going to die. Um, but is the formula calculated? No, the formula to calculate your benefit it is set. It is set. So the formula is set. They're going to tell you exactly what you're going to get every single month. That's what you're going to get every single month, with the exception of a possible inflation adjustment. And again, you'll understand it more, your Social Security benefits more specifically, if you go out to the Social Security website and they do explain how it's calculated. We explain how it's calculated too. We take a little deeper dive into that Social Security webinar as well. So, um, all right. Yes, I agree. Right now, we all need a crystal ball, right? How long am I going to live? You could tell me that, boy, I can nail it. I can nail it by when you should take Social Security, when you should start drawing down on your retirement benefits. I agree. We do kind of need a crystal ball. How's the market going to do? What should I invest in? Crystal ball would come in handy. I agree. All right. Well, thank you everyone, for everyone who stayed on. I appreciate your time today. Again, just reach out to us. I'm going to go back actually on the slide to that one-on-one. Love to see and talk to each of you individually. So again, feel free to schedule a one-on-one with one of the advisors at our team. Everybody has a specific situation. Everyone has a different scenario, different challenges. So we can really hone in on what you're concerned about in a one-on-one meeting. So we love doing those meetings. If for some reason you can't find a day or time that works for you, then just email me at gina@401kplanprofessionals.com. We'll find a day and time that works for both of us, okay? All right. Well, thank you guys again. I'm going to sign off here and appreciate your time.